India built $2.3 trillion in highways, ports, and airports. 67% sit empty. We're at stage 4 of a 7-stage infrastructure collapse that ends with foreign control of your logistics backbone within 24 months. Picture the Ministry of Finance, New Delhi, March 2025. An analyst pulls up the bond auction results. The coverage ratio, buyers per dollar of debt, reads 1.1 times. 2 years ago, it was 3.2 times. The Delhi-Mumbai Expressway, $13 billion invested, needs 65,000 vehicles daily to break even. It's getting 18,000. The Mumbai-Ahmedabad bullet train, $17 billion sunk, sits 23% complete with no completion funding. Across 12 major ports, capacity utilization is 34%. The debt maturity wall hits in 36 months. $312 billion due. The question isn't whether India liquidates infrastructure. It's whether you notice Chinese state-owned enterprises and sovereign wealth funds buying your ports at 30 cents per dollar before the auction closes. This is stage 1. Here's why this matters to you. Every rupee spent building highways nobody uses is a rupee, not spent on schools, hospitals, or keeping your taxes low. Between 2014 and 2024, India committed $2.3 trillion. That's $1,650 in debt liability for every Indian citizen to infrastructure buildout. The boardroom logic was clean. Build it and they will come. GDP growing at 8% annually, middle class expanding, car ownership rising. The National Highway Authority floated bonds backed on one assumption. Traffic would grow 12 to 15% per year, every year, for 20 years. New Delhi, Ministry of Finance, 2016. The infrastructure blueprint covers the wall. Golden quadrilateral expansion, 100 smart cities, Mumbai-Ahmedabad bullet train, dedicated freight corridors. The funding model, 89% debt financed through infrastructure bonds. The government provides sovereign guarantees, meaning when projects fail, taxpayers eat the loss. Investment banks structure the bonds. Domestic banks buy them, often under regulatory pressure. Foreign investors pile in chasing yields 280 basis points above U.S. Treasuries. The debt machine runs smooth. Let me be completely clear about how this works. The leverage tool is government risk underwriting for private cash flow, dressed up as public-private partnership. Here's the mechanism. Private developer agrees to build highway. Government guarantees minimum traffic revenue. If toll collections fall short, government covers the gap. The developer gets paid regardless. The risk sits entirely on the public balance sheet. 89% of the $2.3 trillion gets borrowed. Infrastructure bonds carry 7.8 to 8.9% coupons. The math only works if toll revenue grows at 12% annually to cover debt service. They build toll plazas every 60 kilometers. They install FASTag electronic collection. They project revenue curves that assume Indian traffic patterns will mirror China's highway boom. Here's what this means for you. The government now spends 42% of tax revenue on debt service instead of public services. Teacher salaries delayed, hospital budgets cut, all to pay bond coupons on roads that sit empty. The bond issuance creates artificial demand. Domestic banks, pressured by regulators to support national priorities, load up on infrastructure paper. Their balance sheets become increasingly tied to project success. When projects fail, bank non-performing assets spike, credit tightens, small business lending dries up. You might be thinking, but infrastructure drives growth. Even if some projects underperform, the network effect pays off long-term. Here's the problem with that assumption. The build-out assumed traffic growth that required GDP to hit 8 to 9% annually. India's GDP growth is 5.4% in 2024. The gap isn't small. The Delhi-Mumbai Expressway needs 65,000 vehicles per day to break even on its bonds. It's getting 18,000. That's not underperformance. That's a 72% revenue miss. You can't network effect your way out of a demand collapse. Malaysia, 1994. The government committed $65 billion to infrastructure, highways, airports, Petronas Twin Towers, assuming 9% GDP growth would continue forever. By 1997, they'd built the Pias highway system with traffic projections that assumed Malaysian car ownership would triple in 5 years. It didn't. And that's just stage 1, the setup. Stage 2 is where the traffic projections collide with reality, and the first wave of covenant breaches begins. This is stage 2. We just entered stage 2 in mid-2023 when the National Highway Authority released traffic data showing 67% of toll roads missing revenue targets by 60% or more. Here's why this matters to you. When toll roads don't generate revenue, operators raise toll prices to meet bond obligations. Your 280 rupee trip from Gurgaon to Jaipur just became 420 rupees, even though traffic dropped. You're paying more to use an emptier road. The covenant breach begins. Infrastructure bonds were sold with specific performance triggers. If toll revenue falls below 75% of projections for 2 consecutive years, acceleration clauses kick in. Bondholders can demand early repayment. National Highway Authority of India Headquarters, 2023. The traffic report lands. Across 41,000 kilometers of national highway toll roads, actual traffic is 42% of bondholder projections. The Eastern Peripheral Expressway around Delhi, built for 120,000 vehicles daily, sees 31,000. The Purvanchal Expressway in Uttar Pradesh gets 23,000 daily versus 89,000 projected. The analyst runs the number, 340 billion rupees annual revenue shortfall. That's 340 billion rupees the government must cover under sovereign guarantees or default begins. Here's how the margin call works. Bonds were structured with debt service coverage ratios of 1.4 times minimum. That means toll revenue must be 1.4 times annual debt payments. When traffic misses by 60%, the ratio drops to 0.6 times. The project is bleeding cash. Bond covenants trigger. First, dividend restrictions. No distributions to government shareholders until the coverage ratio recovers. Second, additional collateral requirements. The Highway Authority must pledge other assets to cover the gap. Third, acceleration rights. If the ratio stays below 1.0 times for 18 months, bondholders can declare default and demand immediate repayment. Here's the kicker. The government can't let highways default. Sovereign guarantees mean they must step in. But stepping in requires either raising taxes, cutting spending elsewhere, or issuing new debt to cover old debt. Here's what this means for you. States cut education and healthcare budgets by 18% in 2024 to cover infrastructure guarantees. Your daughter's school loses 2 teachers. Your local hospital delays equipment purchases. The money flows to bondholders instead. Toll increases create perverse incentives. Small businesses start routing trucks around toll roads, adding 40 to 90 minutes to delivery times. Logistics costs spike. The 50 rupee cost per kilometer rises to 73 rupees. That cost gets passed to consumers. Your 800 rupee grocery bill becomes 920 rupees. You might be thinking traffic will recover when the economy rebounds. This is just a temporary slowdown. Here's the problem with that assumption. The projections didn't just miss, they were structurally delusional. They assumed India would add 18 million cars annually. Actual additions are 6.2 million in 2023. Down from 7.8 million in 2019. They assumed fuel prices would stay stable. Diesel hit 94 rupees per liter, killing truck traffic. And here's the elephant in the room. India built highway capacity for 380 million vehicles. Current vehicle population is 210 million. Even if growth rebounds to 8%, it takes 11 years to fill the capacity. The bonds mature in 7. Malaysia, 1996. Plus, highway traffic grew at 6% instead of projected 15%. By early 1997, toll revenue was missing targets by 2.4 billion ringgit annually. The government had guaranteed minimum returns to bondholders, meaning taxpayers covered the shortfall while highways sat empty. That's stage 2, the revenue collapse. Stage 3 is where the rollover crunch hits, and India faces the choice every distressed borrower faces. Pay up or restructure. This is stage 3. We're entering stage 3 now in early 2025, as bond auction coverage ratios drop below 1.5 times, and the Asian Development Bank begins technical assistance missions. Here's why this matters to you. When the ADB, or International Monetary Fund, shows up with bridge financing, the money comes with covenants that force fuel subsidy removal and privatization. That 12 rupee per liter jump in diesel costs, that's the covenant at work, and it hits your wallet within 90 days of loan signing. The rollover crunch arrives. Between 2025 and 2027, $312 billion in infrastructure bonds mature. The government must find buyers for $9 billion in new bonds every single month just to refinance existing debt. But auction coverage, the ratio of bids to bonds offered, has collapsed from 3.2 times to 1.4 times. Reserve Bank of India, March 2025. The bond auction results flash on screens. 75,000 crore rupees offered. Bids received are 105,000 crore rupees. Coverage ratio is 1.4 times. 2 years ago, the same auction would have drawn 240,000 crore rupees in bids. The market is stepping back. Foreign investors watch India's debt to GDP hit 84%. They see foreign reserves at $625 billion, enough for 9 months of imports plus debt service, but not 12. The risk calculation shifts. They demand higher yields. The government must now pay 8.9% versus 7.2% 2 years ago. That's 180 billion rupees more in annual interest expense. Phone rings, Asian Development Bank. We'd like to discuss a bridge facility. Let me be completely clear about how this trap works. ADB offers $8 to $12 billion to cover immediate rollover needs. The interest rate looks reasonable at 4.8%, but the covenants are the poison pill. Covenant 1, fiscal consolidation targets. India must reduce deficit from 6.4% to 4.2% within 24 months. Only 2 ways to do that: raise taxes or cut spending. Since raising taxes kills growth further, the cut comes from subsidies. Covenant 2, subsidy removal. Diesel, kerosene, cooking gas. Subsidies must phase out. That's 2.1 trillion rupees in annual savings, but it means fuel prices jump 12 to 15 rupees per liter overnight. Covenant 3, privatization commitments. The government must sell stakes in ports, highways, airports, power plants, sufficient to raise $35 billion within 36 months. The assets go to auction. Foreign investors, positioned and waiting, submit bids at 30 to 35 cents per dollar of book value. Covenant 4, guaranteed returns for infrastructure buyers. To attract bidders, government must guarantee 16% internal rate of return for 25 years. If toll revenue doesn't hit targets, taxpayers cover the gap. Here's what this means for you. Middle-class family fuel costs jump 3,600 rupees per month. That's $43. Motorcycle commuters can't afford the jump. They shift to overcrowded buses. Productivity drops. Delivery costs for everything from vegetables to electronics spike 18 to 25% as trucking costs rise. Small manufacturers face impossible math. Diesel generators run their factories during power cuts. 94 rupee per liter diesel becomes 109 rupees per liter. Operating costs spike 23%. They either raise prices, losing customers, or eat losses, heading toward closure. Industrial production growth falls from 4.1% to 1.8%. You might be thinking, but if subsidy removal stabilizes the budget, it's worth short-term pain for long-term gain. Here's the problem with that assumption. The subsidy removal doesn't stabilize the budget, it just shifts where the bleeding occurs. Fuel costs spike, killing consumption. GDP growth falls further. Tax revenue drops. The fiscal math gets worse, not better. Meanwhile, the privatization covenant forces asset sales during maximum distress. India sells ports worth $120 billion for $38 billion. That's not stabilization. That's liquidation. Now we have to address the elephant in the room. The critical breakpoint. If foreign reserves drop below $550 billion before privatization auctions complete, currency defense becomes impossible. The rupee crashes, import costs explode, inflation spikes to 9 to 12%, and the government loses all negotiating leverage. Buyers can wait another 6 months and get assets at 20-cent valuations instead of 30-cent. Malaysia, August 1997. IMF approves $1.2 billion bridge facility. The covenants. Remove fuel subsidies, privatize highways within 18 months. Guarantee 16% returns to foreign infrastructure buyers. The rescue was the setup for the liquidation. Within 24 months, Plus Highway sold to foreign consortium at 40% of book value. That's the bridge loan trap, stage 3. Stage 4 is where the assets actually strand, sitting idle while the auction clock counts down. This is Stage 4. We are here right now. Asset stranding. Infrastructure sitting idle, bleeding cash, awaiting the auction. Here's why this matters to you. When foreign firms buy Indian ports at 30-cent valuations, they control import costs for the next 30 years. That 50,000 rupee refrigerator you're planning to buy, it becomes 62,000 rupees because port fees jump 18% under new management optimizing for profit, not national interest. The auction mechanics begin. Ministry of Finance releases the privatization list. 6 major ports, 840 kilometers of highway concessions, 14 airports, 3 power plants. Estimated book value is $127 billion. Reserve price set at $38 billion. That's 30 cents per dollar. Jawaharlal Nehru Port Trust, Mumbai, India's largest container port. Capacity is 10 million 20-foot equivalent units annually. Current utilization, 3.1 million units. That's 31%. The cranes sit idle, berths empty. The Port Authority loses 340 crore rupees monthly. The auction announcement goes out. Bidders: DP World from Dubai, PSA International from Singapore, Costco from China, Brookfield Infrastructure. They submit technical bids, financial bids. The government evaluates. DP World wins with $4.2 billion for a 30-year concession. JNPT's book value is $13.8 billion. Recovery rate is 30.4%. The handover happens in 120 days. Here's how the fire sale mechanics work. A DB bridge loan requires $35 billion in privatization proceeds within 36 months. But infrastructure assets are illiquid. Normal sale process takes 18 to 24 months. Due diligence, environmental reviews, stakeholder consultations. The government can't wait. They compress the timeline to 6 to 9 months. That immediately cuts valuations by 20 to 30%. Buyers discount for execution risk and limited competition. Then add distress discount. Everyone knows India must sell. Buyers bid 30 to 35 cents, knowing there's no alternative. The concession terms lock and control. 30-year operating rights, guaranteed tariff increases indexed to inflation, plus 4%, restricted government oversight, international arbitration for disputes. The buyer gets pricing power and legal protection. Here's what this means for you. JNPT handles 40% of India's containerized imports. Under government operation, port fees are $180 per 20-foot equivalent unit. Under DP World concession, $265 per unit, matching their Dubai terminal rates. That $85 per unit increase gets passed through. Your imported electronics, car parts, machinery, all cost 12 to 18% more. Domestic manufacturers lose competitiveness. Imported inputs cost more. Their export containers pay higher fees. A Bangalore tech exporter ships 200 containers monthly. Port fee increase is $17,000 per month. That's $204,000 annually. That comes straight out of margins. Either prices rise, losing export orders, or layoffs begin. You might be thinking, but private operators run ports more efficiently. Lower costs offset higher fees. Here's the problem with that assumption. Efficiency gains are real but small, maybe 8 to 12% cost reduction. The fee increase is 47%. The operator isn't improving efficiency for your benefit. They're optimizing for 16% guaranteed internal rate of return over 30 years. Every efficiency gain goes to profit, not lower fees. And here's the kicker. The concession includes tariff floors. Fees can't drop below $240 per unit, even if costs fall. You're locked into high prices for 3 decades. Malaysia, 1998 to 1999. Penang Port, book value $890 million, sold to PSA Singapore for $340 million. Kuala Lumpur International Airport expansion, $1.2 billion invested, completed by foreign consortium at 28% of sunk cost. The pattern: world-class infrastructure, sold at fire sale prices during 24-month distress window. That's Stage 4, the stranding and the sale. Stage 5 is the final tally. Who owns what, where the cash flow goes, and why the new ownership structure is nearly impossible to reverse. This is Stage 5, the final balance sheet. By 2027, here's what India's infrastructure ownership looks like. Foreign control, 8 of 12 major ports, that's 67% of container capacity. 2,400 kilometers of premium highways, golden quadrilateral segments, 22 airports including 4 metros, 12 gigawatts of power generation. Annual cash flow leaving India, $23 billion in concession fees, toll revenue, and port charges. Here's why this matters to you. That $23 billion is $23 billion not reinvested in maintaining roads, upgrading ports, or building new capacity. It's dividend payments to Dubai, Singapore, and Beijing. Your infrastructure deteriorates faster while ownership profits offshore. Ministry of Finance, December 2027. The analyst pulls the final report. Assets sold, $847 billion book value. Proceeds received, $290 billion. Recovery rate is 34.2%. The remaining debt after asset sales is $557 billion, still requiring rollover and service. But the ownership transfer is complete. The concession agreements are signed, notarized, and filed in international arbitration venues. Reversal would require buying back concessions at market rates, estimated $680 to $890 billion, far more than the sale price. Bottom line, here's how the final control stack works. Port concessions held by special purpose vehicles in Singapore and UAE. Toll road operations managed through Mauritius subsidiaries, tax treaty benefits. Power plants owned by Canadian pension funds via Dutch holding companies. Revenue flows. Toll collected in India, transferred to special purpose vehicle, management fees to parent, dividends to ultimate shareholder. Tax leakage at each step. Net revenue retention in India is 34% of gross toll collection versus 78% under government operation. The governance shift. Tariff decisions now made in Dubai boardrooms, not New Delhi ministries. Capacity expansion decisions optimized for internal rate of return, not national logistics needs. The infrastructure serves shareholder returns, not economic development. Here's what this means for you. Highway maintenance budgets cut 40% to maximize toll profit margins. Pothole repairs delayed, resurfacing pushed from 8-year to 14-year cycles. Your vehicle maintenance costs jump 18,000 rupees annually from rough roads. The revenue extraction creates permanent drag. $23 billion annually leaving India is $23 billion not available for education, healthcare, or new infrastructure. It's a 0.7% permanent reduction in available fiscal resources. Compounded over 30 years, that's $1.1 trillion in foregone domestic investment. You might be thinking, but at least the debt is reduced and the infrastructure exists. Here's the problem with that assumption. The debt reduction is partial. $290 billion recovered against $847 billion in assets. Net debt only drops $290 billion, while India surrenders $23 billion annually in revenue. Break-even on that trade is 12.6 years, but the concessions run 30 years. India is net negative for 17-plus years. Malaysia, 2001. Final accounting of Asian financial crisis liquidation. Plus highway foreign-controlled, Penang Port to Singapore. PSA, KLIA, Airport. Expansion to foreign consortium. Petronas non-core assets sold. Annual cash flow leaving Malaysia, $2.8 billion in concession fees, dividends, and management charges. The infrastructure remained, but the revenue left. That's the balance sheet. Stage 5 complete. The infrastructure remains. The ownership doesn't. We've completed 5 of 7 stages. The pattern says Stage 6 triggers when the next infrastructure wave, smart cities, inland waterways, hits the same debt wall, and the cycle repeats. Same room, same screen, different numbers. Ministry of Finance, New Delhi. The analyst opens the file marked 2029 Infrastructure Pipeline. Smart Cities, Phase 2. Inland Waterways Expansion. High-speed rail extensions. Projected cost, $1.8 trillion. Proposed funding, 87% debt financed. The coverage ratio from last month's auction still blinks on the adjacent monitor. 0.9 times. Below par, the first time since the 2025 crisis, that buyers demanded more yield than government could pay. The concession agreements from 2027 sit in the archive. Dubai owns the ports. Singapore controls the highways. Beijing holds power generation. $23 billion leaves annually. The question was never whether to build. It was whether anyone would notice the terms had already changed before the next auction opened.